significant transformations driven by shifts in policy, technological advancements, and evolving geopolitical dynamics. In the early post-war years, the EU and its predecessor communities relied heavily on coal and oil, fueling the region's industrial growth. By the 1970s, oil had become a dominant source of energy, accounting for a large portion of EU consumption. However, the oil crises of the era prompted the EU to diversify its energy sources and reduce dependence on external suppliers. From the 1980s onward, natural gas gained importance, with significant volumes sourced from the North Sea and Russia, which emerged as a major external supplier. Meanwhile, nuclear power expanded, particularly in France, where it provided a substantial share of the country's electricity. By the early 2000s, nuclear energy accounted for about a quarter of the EU's electricity, and natural gas became a key source for heating, industry, and power generation. The 2000s and 2010s marked a major shift as the EU placed greater emphasis on climate policies and renewable energy targets. Wind and solar power experienced rapid growth, driven by technological advancements and cost reductions. By 2020, renewable energy's share in gross final energy consumption surpassed 20%, and these sources began to compete with coal and, in some cases, natural gas for a central role in Europe's energy mix. Geopolitical tensions in recent years have tested the resilience of these evolving energy systems. Following the conflict between Russia and Ukraine, the EU imposed sanctions on Russia, which had long been a significant supplier of natural gas, providing over 40% of Europe's imports before 2022, as well as oil and coal. Restrictions on Russian energy exports, combined with countermeasures from Russia, caused volatility in European energy markets. Many EU member states, which had depended on Russian pipelines for decades, faced supply disruptions and price spikes as they sought alternative suppliers and expanded LNG import capacity. The EU's recent legislative efforts to accelerate its green energy transition have added complexity to an already challenging energy landscape. Under the European Green Deal and the subsequent Fit for 55 package, the EU aims to reduce greenhouse gas emissions by at least 55% by 2030, compared to 1990 levels, and achieve climate neutrality by 2050. To meet these goals, the EU has proposed more ambitious targets for renewable energy and energy efficiency, revising key directives and introducing new regulations to raise the bar for member states. A key piece of legislation, the revised Renewable Energy Directive, sets binding targets for renewable energy. In March 2023, negotiators agreed to increase the share of renewables in the EU's overall energy consumption to 42.5% by 2030, up from the previous target of 32%. This significant increase in ambition will require a rapid expansion of wind, solar, and other low-carbon technologies. At the same time, initiatives like the updated Energy Efficiency Directive and the Emissions Trading System, ETS, are tightening carbon markets and encouraging faster decarbonization across various sectors, from power generation to transport and buildings. However, these heightened environmental standards come at a time when Europe's energy systems are already under strain. The disruption of traditional fossil fuel supplies, particularly those from Russia, has placed significant pressure on European energy markets. The reduced imports, coupled with high and volatile gas and electricity prices in 2022 and 2023, forced member states to seek alternative energy sources, often on short notice. This situation has renewed the focus on energy diversification and self-reliance, but also created near-term challenges for countries still reliant on coal and gas as bridging fuels. Europe is currently facing an unprecedented energy crisis, shaped by a confluence of factors: declining Russian gas supplies, erratic renewable energy production, escalating geopolitical tensions, and seasonal constraints on key energy sources. Against the backdrop of shifting global alliances and internal political instability, European policymakers and industry stakeholders are navigating an increasingly complex energy landscape. Recent data and market trends underscore the fragility of Europe's energy security and highlight the urgent need for diversified, stable, and sustainable energy solutions. Historically, Russia was Europe's most significant single supplier of natural gas. As recently as 2021, Russia provided over 40% of the EU's gas imports, totaling around 155 billion cubic meters annually. This volume was a cornerstone of Europe's energy security strategy, with Russian pipeline gas often being one of the most cost-competitive and readily available options. A significant portion of these deliveries, estimated at 40 to 50 billion cubic meters per year, transited through Ukraine's extensive Soviet-era pipeline network, known as the Brotherhood System. This Ukrainian transit route, which predates newer pipelines like Nord Stream and Turkstream, was the primary pathway for Russian gas to the EU until the mid-2010s. The share of Russian gas flowing into Europe has gradually declined in recent years, particularly with the construction of alternative energy routes. Despite this shift, Ukraine's pipeline system has remained a critical conduit for Russian gas, supplying several European countries, including Slovakia, Austria, the Czech Republic, and others further afield. However, the expiration of the current gas transit agreement between Russia and Ukraine, set to expire on January 1, 2025, presents a significant challenge to this established arrangement. The current agreement, signed in late 2019, initially guaranteed the transit of at least 65 billion cubic meters, BCM, of Russian gas through Ukraine in 2020, with this volume being reduced to 40 BCM annually from 2021 through 2024. As the conflict in Ukraine escalated throughout 2022, European imports of Russian pipeline gas plummeted, a direct result of both the ongoing war and the EU's political response. By the end of 2022, Europe had significantly reduced its reliance on Russian gas, cutting imports by more than half compared to pre-war levels. This shift was primarily driven by a pivot toward liquefied natural gas, LNG, and an increased reliance on non-Russian pipeline gas sources, such as Norway and Azerbaijan. Nevertheless, even amidst the war, some Russian gas continued to reach European consumers via Ukraine. In 2022, the Ukrainian pipeline accounted for approximately 5 to 10% of the reduced volumes of Russian gas entering the EU, a relatively small but notable figure when considering that overall Russian gas shipments to Europe had fallen to between 60 and 80 BCM, down from the 155 BCM seen in 2021. The potential absence of a new transit contract between Russia and Ukraine could lead to the complete cessation of this pipeline route by early 2025. If this were to happen, one of the last remaining pipelines delivering Russian gas directly into the European Union would be shut down. This would make Europe even more dependent on alternative energy sources, such as LNG, while also increasing its exposure to higher global LNG prices and the logistical challenges associated with these imports. The disruption could drive further momentum for the EU's strategy to transition towards renewable energy sources, enhance energy storage capacity, implement energy efficiency measures, and diversify its energy supply channels in an effort to safeguard long-term energy security. In Austria, a country historically dependent on Russian natural gas, the geopolitical shifts brought on by the invasion of Ukraine have led to major disruptions in energy supply. Austria's national oil and gas company, OMV, had long relied on Russian gas as a cornerstone of its energy security, a relationship that dates back to the Soviet era. Prior to the conflict, Russian gas typically accounted for over 50% of Austria's annual natural gas consumption, with Austria consuming around 9 BCM of gas annually, primarily for heating, industrial processes, and power generation. Long-term contracts with Gazprom ensured a stable supply and predictable pricing. However, the war in Ukraine and subsequent European sanctions against Russia fundamentally changed this dynamic. In 2022, amidst rising political tensions and a shifting payment structure, Gazprom halted deliveries to OMV, highlighting the fragility of Austria's reliance on Russian gas. After months of uncertainty, OMV made the historic decision in early 2024 to terminate its long-term gas contract with Gazprom, effectively severing a decades-long commercial relationship. This move marked a decisive break with a key energy supplier and underscored the vulnerability of Austria's energy security in the wake of shifting geopolitical realities. With domestic production in Austria covering only a small fraction of its annual energy needs, the reduction of Russian gas supplies has forced the country to seek alternative sources. Among the options being explored are increased imports of gas via pipeline from Norway, which has become a crucial supplier to many EU countries since the crisis began. Austria is also looking to North Africa, specifically Algeria, as a potential source of additional gas supplies. While Austria does not have its own LNG terminal, it can take advantage of the expanding LNG infrastructure in neighboring countries, such as Italy and Germany. These countries have increased their LNG terminal capacities, with Germany developing floating LNG terminals on its North Sea coast, and Italy expanding its regasification capabilities. These new and expanded terminals provide a route for LNG cargoes from global suppliers like the United States, Qatar, and others. Meanwhile, Germany, a key player in Europe's energy landscape, has become increasingly reliant on wind energy as a central component of its renewable energy strategy. By the end of 2023, Germany's installed onshore wind capacity had surpassed 67 gigawatts GWO, and the country typically relies on wind for about 20 to 25% of its annual electricity generation. However, the intermittency of wind power remains a significant challenge. During certain periods, such as the low wind phases of late 2023 and early 2024, Germany saw its wind energy output drop by as much as 30% below seasonal norms. This forced the country to ramp up its use of gas-fired power plants and, in some cases, coal-fired generation to meet electricity demand. Such a shift not only drives up wholesale power prices, often surpassing $150 per megawatt-hour during peak periods, but also undermines the emissions reductions achieved through the expansion of renewable energy sources. Norway, long considered the battery of Europe due to its abundant hydropower resources, plays a critical role in stabilizing the European energy grid. In 2022, Norway exported over 20 terawatt-hours (TWh) of electricity to neighboring countries, helping to maintain stability in the integrated European power market. Historically, Norway's hydropower has provided a reliable backup to wind energy in northern Europe. However, with reduced wind generation across much of Europe, Norway's role has become even more crucial, providing essential support during low wind periods. As Europe continues to navigate these shifting energy dynamics, it is clear that the coming years will require significant adjustments. Countries like Austria and Germany are being forced to diversify their energy sources and infrastructure to ensure stable and affordable energy supplies. At the same time, the EU's broader energy transition efforts will need to focus on enhancing energy storage, expanding renewable energy capacity, and reducing dependence on external fossil fuel suppliers. In doing so, Europe hopes to build a more resilient and sustainable energy future. The rapidly rising demand for energy, coupled with a series of other challenges, has led to electricity prices in southern Norway reaching unprecedented heights, at times exceeding $200 UR per megawatt hour. This sharp increase is a striking contrast to the historically low domestic rates that Norway once enjoyed, which were often below $20 to $30 EUR per megawatt hour prior to the crisis. This surge in electricity costs has put significant pressure on political leaders within Norway, prompting growing calls to renegotiate or even restrict the cross-border power interconnectors linking Norway to Denmark, Germany, and the UK. Policymakers in the country are becoming increasingly concerned that excessive exports of electricity may undermine Norway's energy affordability and security. This growing concern has led to a delicate reassessment of international energy cooperation, as the government grapples with the potential impacts on domestic consumers and the broader energy landscape. Meanwhile, in France, the political landscape has been significantly affected by a crisis that has shaken the country's government. France operates 56 nuclear reactors, with a total installed capacity of approximately 61 to 63 gigawatts, GW. Historically, these reactors have provided more than 70% of France's domestic electricity, making the country one of the world's most nuclear-reliant nations. Beyond its own energy needs, France also exports a substantial amount of surplus power. In the first 11 months of 2024 alone, France exported around 84 terawatt-hours of electricity, marking an 85% increase compared to the same period in 2023. These exports were primarily directed toward countries like Italy, Germany, and the UK, and have often served as a stabilizing factor within the European Union's internal energy market, particularly during periods of low renewable energy output or unexpected outages in neighboring regions. However, the political instability caused by the sudden collapse of the French government in late 2024 has raised concerns about the future of energy policymaking and regulatory oversight in the country. The potential for a prolonged political deadlock could lead to delays in nuclear reactor maintenance schedules, hinder the restarting of reactors, or result in changes to the country's export policies. Even a short-term reduction in French electricity exports, by as little as 5 to 10 TWh annually, could trigger significant price spikes in neighboring markets, which are already experiencing tight margins and limited spare capacity. This potential shift poses strategic risks for the European Union, as countries that rely heavily on French electricity may be forced to seek more expensive alternatives, such as LNG-fired generation or emergency power imports from less stable sources. At the same time, the solar photovoltaic (PV) capacity in the European Union continues to expand. By mid-2024, the EU's total solar capacity surpassed 240 GW, reflecting over a decade of significant investment and subsidized growth in the sector. During peak summer months, solar energy can account for up to 10 to 15% of the EU's electricity demand, providing a critical source of power on sunny days. However, this contribution drastically declines during the winter months, when solar output can fall to less than one-third of summer levels due to shorter daylight hours and a lower solar angle in northern Europe. In December, for example, solar farms in Germany produced only 2 to 3 TWh, compared to 7 to 8 TWh in July. This seasonal decline in solar output forces the EU to rely more heavily on dispatchable sources of power, such as natural gas, coal, nuclear, or energy imports, to meet peak winter demand. The variability of solar energy generation during these months intensifies competition for energy resources, already strained by geopolitical constraints and dwindling Russian gas supplies, which have been pushing energy prices upward. Furthermore, tensions between the US and the EU have been reignited by the potential re-election of Donald Trump in the 2024 US presidential race. This has raised uncertainties regarding the future of transatlantic energy cooperation. Under the previous America First policies, the US had considered imposing tariffs on various imports and hinted at renegotiating trade deals to favor domestic producers. Such policies could potentially inflate the cost of US LNG, which has become an increasingly important alternative to Russian pipeline gas since 2022. In 2022 and 2023, the EU imported a record 55 to 60 billion cubic meters (BCM) of LNG from the US, up from around 22 BCM in 2021. If tariffs or other restrictive measures are imposed, the cost of importing LNG could rise by 2 to 3 EUR per megawatt hour, according to some market analysts. Countries in Eastern Europe, such as Hungary and Slovakia, are particularly vulnerable to these developments. Historically, these nations relied on Russian pipeline gas via Ukraine, but now they face the compounded challenge of adjusting to the cessation of direct Russian gas flows, while also grappling with the potential impacts of shifting US trade policies. For example, Hungary imported over 8 BCM of natural gas in 2022, more than half of which came from Russia. If US LNG becomes less competitive or harder to secure, these countries may find themselves scrambling for alternative supplies from the southern gas corridor, which includes countries like Azerbaijan and Turkey. Additionally, they may need to ramp up storage investments or implement more energy efficiency measures to buffer against potential price shocks.